All right, everybody, welcome to the Chapter 9 guided assignment. Here we're going to do depreciation by 3 different methods and with partial years. Okay, so that's going to throw us off a little, and I'll try to explain it. So here we have this company. They purchased equipment for $48,270. It's expected to have a useful life of 3 years or 6,600 operating hours and a residual value of $2,070. And then it tells us how much the equipment would be used in each year. So we're supposed to determine the amount of depreciation expense for the first year, second year, third year, fourth year using all 3 of these methods. So we'll start with the straight line method. And so with the straight line method, all we do to figure out the amount of annual depreciation is just take the cost, $48,270, minus the residual value, $2,070. So that gives us a number that's called the depreciable value, or the amount that we're planning to depreciate during the asset's useful life. And then we just divide that by the useful life in years. So in this case, it's 3. So the plan is to depreciate $15,400 worth of this asset, meaning we're going to take a depreciation expense, and then we're gonna credit the accumulated depreciation account that's attached to the asset. This would be super easy if we had purchased this asset on January 1st, because then we would just have 3 years and it would be $15,400 for each of the 3 years. But because this asset was purchased on April 1st, we're going to have a partial year on the first year and a partial year on the last year, year 4. The 2 middle years will actually depreciate a full year's worth of the asset's cost, so $15,400. So since this asset was purchased on April 1st, that means we'll own it from April 1st all the way through December 31st in that first year, which is 9 months. So to figure out how much depreciation expense for that first year, we can just take $15,400 divided by 12. That gives us a monthly depreciation amount, and then multiply that by 9. So in that first year, we'll do 9 months, or $11,550. And then in the last year, in year 4, we're just going to have it for January, February, and March until it reaches its full 3 years of depreciation. So to figure out how much that is, we'll take a full year's worth, $15,400, divided by 12 to get a monthly, and then multiply it by 3. That gives us $3,850. And that's it. So even though it's only a 3-year asset, it takes us, it's going to be spread out over 4 years, because we're going to do 9 months worth of the depreciation in the first year, all 12 months in the second year, all 12 months in the third year, and then 3 months worth of depreciation in the last year. So we're ending up doing a full 36 months worth of depreciation, but it's spread out differently because it's a partial year in the beginning and in the end. So there's straight line. So the second is the units of activity method. Here, what we're going to do is, instead of dividing it by time, we're going to divide it by how many units of activity are in the asset's life. In the case of this equipment, it's operating hours. So to do that again, we take the cost, $48,270, and we subtract the residual value, $2,070, to get our depreciable value. And then we divide that by its useful life in operating hours, so 6,600. And that gives us $7 per operating hour. So to figure out our depreciation, we're just going to take the number of operating hours we use the equipment in a year and multiply that by $7 per hour. So in year 1, we use the asset for 2,300 hours. So we'll just take 2,300 times 7, and it'll be 16,100. Oh, what? No, sorry, it's 1,200 in the first year. That's my mistake. So 1,200 times 7, 8,400. In the second year, it's 2,300. If I had a good memory, I'd remember that, but I'll just do it again. 2,300 times 7 is 16,100. 2,000 hours in year 3, so 7 times 2,000 is 14,000. And in year 4, we have 1,100 hours, so 7 times 1,100 is 7,700. So those are our first 2. Probably should use a check to make sure I didn't make an error. Looks like we're good. So in the third scenario here, we're going to use the double declining balance method. This is a little bit more confusing. So the first thing we have to do with the double declining balance method is figure out what our double declining depreciation rate is going to be. To do that, what we do is we first figure out what our rate is if we were doing straight line. So by doing that, we take 100%, which is 1, right? 100% divided by 3, the number of years in the useful life. And that tells us the straight line depreciation rate, 33%, which is 1/3 of the value's cost each year. Then, because it's the double declining balance rate, we're going to double that amount. So I'm going to multiply it by 2 and double it. So this gives us our double declining balance rate that we're going to use for figuring out our depreciation expense. So I'm just going to save this in my memory. And now, well, I don't have to, right? I can just type 0.666667 later if I want to. And now we're going to start figuring out our depreciation expense for each year. So with the double declining balance rate, we do not subtract out the residual value up front like we did with straight line and units of activity. Instead, we just take the full cost, 48,270, and we multiply that by our rate. And that gives us a depreciation expense for a full year of $32,180. But part of our problem here is that we don't have it for a full year in that first year. We only have it for 9 months. So I'm going to divide this by 12 and then multiply that by 9. So in our first year, we will depreciate $24,135, which means we'll take a depreciation expense of $24,135 and we'll credit the accumulated depreciation account that much. So now to find the second year's depreciation, what we have to do is figure out what's called our book value. Our book value is our cost minus any depreciation we've accumulated up to that point. So our cost was $48,270. And in that first year, we depreciated $24,135. So our book value is $24,135. It's like we depreciated exactly half of the cost in that first year. So now to figure out the amount of depreciation expense for the second year, we're going to multiply that by our rate. And that gives us $16,090. There's our depreciation for the second year. To find our depreciation for the third year, we're going to take our cost, $48,270, and subtract any depreciation we've accumulated up to this point. So we're going to subtract the first year's depreciation of $24,135, and we're going to subtract the second year's depreciation of $16,090. That means our book value at the beginning of year 3 is $8,045. To find the amount of depreciation expense for the third year, I'm going to multiply that by my rate. And that's going to give me 5,363. It tells me to round to the nearest dollar up here in the instructions. So I'll do 53.63. And that's our depreciation for the third year. So now for the fourth year, it's a little different. We don't worry about rates. We don't worry about anything. Really, all we want to do is make sure that our book value at the end of this depreciation process equals our residual value. So we just are going to depreciate enough to leave us with $2,070. So I'm going to take my cost, $48,270, minus any depreciation we've accumulated to this point. So minus $24,135 from the first year, minus $16,090 from the second year, minus $53.63 from the third year. And I'll see that my book value at the beginning of year 4 was $2,682. I want to be left with 2,070. So I'm just going to subtract 2,070 from that. And that will tell me the amount I need to depreciate in this fourth year to leave us with $2,070. I'll check my work. Looks like I got it right, thank goodness. And that's it. So I hope that was helpful to you, and I hope working through it was helpful. As you can imagine, using Excel to do this could actually speed it up a great deal. But I just wanted to walk you through this process using the calculator. If you have other questions, don't be afraid to reach out and ask them.